Welcome to Trader TV, your insight into trading conditions for professional investors. In this episode, we'll be talking to Brett Chappell, Head of Fixed Income Trading at Nordea Investment Management, about the dealing environment for corporate bonds, and Lee Sanders, Head of Foreign Exchange and Fixed Income Trading at AXA Investment Managers, on trading in the government bond markets this month. While I will update you on some of the latest market data available. We start with the corporate bond or credit markets. Brett, welcome to Trader TV.
Thank you very much. It's a pleasure being here.
Could you tell me, first of all, looking at the investment grade markets for credit, how would you characterise liquidity and pricing in the markets at the moment?
Liquidity, it depends on what you're looking to do. In the investment grade, we have to compete with central banks in Europe that are currently purchasing. Liquidity is difficult. It exists, but there's a cost for it.
Okay.
I think that the conditions are such that, especially with people that want to do anything that's large in scale, you really have to understand how much you're willing to pay and where to go for it if you're on the buy side.
Okay.
Selling, it depends on the name, but generally it's been a little easier to sell paper recently than buying.
Is that partly because the ECB is buying?
Yeah, I would say that's the main event. That's probably it. They tend to come in the investment grade space, but it will depend obviously in the financials. We've seen a little more volatility in those. So there is a liquidity premium out there currently, but we have to understand where the market is and to advise often the portfolio managers on just the depth of the market, so they make their investment decisions.
Got it, thank you. And how does that differ in high yield, European credit?
Well, high yield right now is still being dominated by new issuance, and especially if you look at last month, there was quite a fair amount of new issuance. We're expecting that to continue unabated. What you're seeing is that it also comes down to the allocation levels, and this is something that's having an effect because perhaps a few years ago you might see a lot more hedge funds coming in and flipping and going for the fast money. There's now a larger focus on slow money, which we're noticing, and I think that is helping out. I still am a bit concerned about liquidity. Again, when you try to do larger sizes, anything that's large in scale, you have to be extremely cautious how you approach the market. One, maybe two max, otherwise it'll blow up in your face.
Got it, thank you. And are there any sectors or geographies that are standing out?
Most volatile, I would say, is that looking in the month of October, one of the things that you would see would obviously be the banking area. The Italian banks and of course the Spanish banks. With the political uncertainty that was happening with Catalonia, you were seeing a lot of movement coming in, fast money moving around, and you could see huge swings. So trying to calculate actual net asset values could be somewhat variable during the course of the day. Same history again with Italy, lots of political winds pushing around. What about bad debts? So I'd say the financial sector was the one that probably experienced the most volatility over the past month.
Is there anything that's telling you about what might be occurring in the market coming up?
Yeah, absolutely. I think that this is something that we and Nordea Investment Management are very much on top of, and it's an ongoing work in progress. I think what you have to do to figure out where the market's going to be, you have to know who's doing what. And amongst the systematic internalizers and the banks that are currently providing liquidity, they will indicate in their indications of interest before you're taking this trade. So that will be things such as, Neptune. You'll see Agomi Honeycomb, B2 Scan. Also, data mining over the various entities is very, very important because it'll give you an indication of where the market currently is, where it has been, and you can extrapolate. So that if we have to go out and make a buying decision, perhaps 5-10 years ago, we might have gone out and just asked one market maker, where are you? Here, we can actually decide where we're paying.
Yeah.
And this leads to how we're going to go in the future, because right now we have to be technologically advanced to such an extent that we are price deciders.
Okay.
And that we're still price takers, we're not price makers. We're not inheriting the mantra of mimicking what the banks do. But we have to be price deciders because we have more insight into the prices than a lot of other people, and more so than we had 5 years ago. When we see an extremely aggressive offer, for example, of a bond that's in our universe, we can then approach the portfolio managers and say, listen, you want it here? Now you've got 10, 15 million, 20 million on the offer, and then they can react. So it's actually helping us out by we can provide liquidity when it's needed.
And so you have, and talking of B2 Scan, Alchemy and Neptune, so these are pre-trade data sources that give you insight into where people are in the market before you trade. Okay.
Yes.
And so what does a buy-side trading desk need to do then to prepare itself beyond getting access to this technology? Are there certain asset classes they might be looking at trading, futures rather than cash, these sorts of things? How does a trading desk prepare for the market?
Well, currently right now, I think a lot of the activity comes on what assets people are trading. So you can see for us, we're quite active in futures and credit derivatives, for example.
Yeah.
It's a way of taking a look and according to what our model says. But I would say there are a few things that we have to do right now. One, first and foremost, make sure that you have a good IT infrastructure.
Yep.
And this can include obviously developing things in-house for internal TCA, which is extremely important for all asset classes. And it means also connecting with third-party vendors to find out what they can do. This would require perhaps having open APIs from the MTFs that they obviously are going to be willing and discuss the economics, but for us to do this. We have an EMS, we're working with FlexTrade, for example, and that's helping us to prepare. So right now, to give an example how we can prepare, we look at, as we mentioned, there's very different IOIs beforehand. Once we have those consolidated in EMS, that'll be very helpful. But what's also extremely important is building up a reputation with the other market participants. And this means being credible. And so going forward, to give you an example, you have to have a good relationship with the material risk takers at the banks as well. So that if you call up, let's say I have a large and scale trade, I will not call up one person and another person and another person and another and ask them each where you bid for 10. Yeah. Because the market will go away from us. So you have to be able to interact with one or two max and build up trust, because credibility takes a long time to build up and it takes no time to come down. And so it's very, very important that you have a good reputation in the market.
How do you see the best way to assess transaction cost analysis at the moment within fixed income, if it's possible?
It depends a lot on the internal policies of the Institute. For us, we're building it ourselves because there is no one size fits all. Because someone who's very strong in credit, such as we are, and maybe we're building up emerging markets, those are going to be two very different models, how you calculate TCA for emerging markets than you do for credit. So you have to be flexible. And we're working currently, for example, with an EMS, FlexTrade, which will then allow us to aggregate the data in such a way that we can then both do a pre and post-trade TCA from one platform that is independent of our OMS.
So how do end investors need to think about the buy-side trading desk now and the value it adds to the investment process?
They have to realize that in terms of coming with risk-adjusted returns for the investors, that trading, compared to, let's say, just 5 years ago, is now an integral part of that. So they have to be aware of that. They also have to realize that for best execution, which is extremely important, that having an approved broker list and knowing the LEI numbers of each individual broker that we have or counterparty is extremely important, and that we've gone through the due diligence, because if they have an approved list, it's probably very important that they also use ours. But that needs to be communicated from a sales perspective, I would imagine, to the funds.
Now let's look at some of the important numbers that are impacting market liquidity and bond prices at the moment. First up, 30 billion euros per month. In October, the European Central Bank opted to decrease its quantitative easing purchases to 30 billion euros per month for 9 months, starting in January 2018. The ECB's quantitative easing programme makes it a major buyer of bonds and significantly affects market liquidity. The Eurosystem, the monetary authority of the Eurozone, has a stated aim of achieving inflation rates below but close to 2% through asset purchasing over the medium term. It began buying public sector bonds in 2015 and corporate sector bonds in 2016. The ECB has been making monthly net purchases in public and private bonds amounting to an average of 60 billion euros per month, down from the 80 billion euros per month that were being acquired between April 2016 to March 2017. As we can see from this graphic, published by UBS in September, there has been a correlation between outflows in debt investment and the ECB QE programme. Analysts at Bank of America Merrill Lynch have said that the October announcement, combined with Mario Draghi's explicit statement that the programme would not stop suddenly, puts the earliest realistic end date for net purchases at December 2018. It also gives the ECB the option of maintaining a trickle of purchases into the beginning of 2019, while still complying with the limits it has set. From a trading perspective, this announcement was not a shock to the system and should not have had any immediate impact, but QE is still the elephant in the room for European liquidity. Interestingly, if we look at the Flow Show report published on the 19th of October by analysts at Bank of America Merrill Lynch, they have seen 43 straight weeks of investment grade bond inflows and a fifth straight week of high yield bond fund inflows as well. The fifth straight week of outflows from government bond funds, while there have been inflows to emerging market debt funds in 38 of the past 39 weeks, inflows into municipal funds in 14 of the past 15 weeks. Of those inflows, 3.6 billion the week that the report was published was put into active bond funds versus just 2.2 billion that was put into bond passives. Looking longer term, that is 1.04 trillion of active bond inflows that have gone into active funds over the past 10 years versus 0.93 trillion into passives. The average daily traded volume for fixed income instruments in Europe for the third quarter of 2017 fell to 90 billion euros from 118 billion euros in Q2 and 128 billion euros in Q1, according to Trax, a market access subsidiary. That means Q3 volume is down 10% on a year ago, when trading volume for Q3 2016 hit 100 billion euros. The steady decline in volume from Q1 to Q2 to Q3 follows the same pattern that we saw in 2015 and 16, with volume peaking in the first quarter, then dropping off to Q3, followed by a plateau or even a slight increase in Q4. The 29% drop in average daily volume from Q1 in 2017 is proportionally greater than last year, which saw a 12% drop in volume from Q1 to Q3 2016, and a little greater than the 22% decline experienced in 2015 over that same period. Corporate investment grade bonds saw average daily volume fall by nearly 20% quarter on quarter, that's from Q2 to Q3, but was on a par with the volume for Q3 2016 at just over 5 billion average daily volume. High yield credit saw average daily volume in Q3 fall 16.5% against Q2, but only saw a 3% drop on last year's Q3 ADV. European government and sovereign bond ADV declined by nearly 24% in Q3 against the previous quarter, and was down 10% against Q3 in 2016. In the US, which typically sees the same pattern of activity as Europe, going from Q1 dropping down to Q3, ADV in Q3 for corporate debt was at 28.7 billion. That's a fall of nearly 20% from Q1, which saw an ADV of 35.8 billion. While Q3 this year was a couple of percentage points up on Q3 2016, last year had only seen a 13% decline in activity between the first and the third quarters. In the US Treasuries market, average daily volume dropped by 12% from Q1 to Q3 to $474 billion US dollars. That's slightly more than the 9% fall experienced in 2016 over those quarters. Now, talking about the government bonds market, earlier I spoke with Lee Sanders, Head of Foreign Exchange and Fixed Income Trading at AXA Investment Managers, about the trading conditions in the government bond market this month and the way that trading desks are adding value to the investment process. Lee, thanks for joining us.
Thanks, Dan.
So, if we look at the liquidity picture for government bonds across the US and the European markets at the moment, how would you characterise liquidity in those different markets?
Well, I think at the moment, in the 26 years that I've sat in this organisation, I would say that liquidity was the best it's ever been. And I think there are a couple of factors for that. I think if you reverse back a year, balance sheet was almost at a premium in the banks. And now that balance sheet is readily available to all of the client base. I think there's a little bit of tiering maybe attached to that, but balance sheet is made available to us, and I think that's a very positive thing. The whole of the government bond market is going very much more and more on platform.
Yeah.
So there's a lot of competition out there, and banks want to seem to be winning that business. And obviously we've got a lot more information around the quality of the execution. So I think you could have been, historically, you could have not liked a particular counterparty for whatever reason, but now the stats will clearly show you who's good, and the balance sheet's there, so liquidity has been absolutely excellent. If you look at our gilt stats, we would say about 90% of the volume would be on platform. In Europe, it would be more like 70.
So we've seen a rate hike from the Bank of England, and there's been talk about what's going to be happening in Europe and the US. When there is a central bank move of that type, how does that affect the trading desk, if at all?
I think it's interesting. I mean, yesterday was a key day, obviously, and I think it was a reflection on central bank policy. and maybe a small shift that we're seeing. But I think we need to remember that the policy is still very easy and loose. And I still think we're washing through the quantitative easing cycle as well. So I think if you look at the execution criteria, things are still good. Mm-hmm. Balance sheet's still available. There's a lot of capital that the banks can deploy. From a liquidity standpoint, it was very interesting. The moves that we saw, lowering yields, maybe surprised a few people, but at no point was liquidity ever compromised through the whole of the day. And most of the activity, I think, was centered around the economists and the strategists as we sort of just worked out what we thought was going to be the next move. But it was, as we all know, a dovish hike.
Absolutely. Are there any particular geographies which have stood out in terms of volatility or illiquidity or variability in pricing?
Yeah, it's very interesting. Obviously, Spain has stood out as an area of volatility. And there has been a lot of volatility at times in the peripheral bond markets, but there's never really been a lack of liquidity.
Yeah.
And RV trades, size trades, which I think a year ago couldn't be done, are now done very easily, and I think almost manifests itself in a lot of RV potential. We are trading RV ideas again, whereas I think that for cost of execution wasn't a fund manager's mandate for quite a period of time now, because you can get through the bid offer or to the midpoint. Mm-hmm. We're happy to put those trades on, and not only in the developed government bond markets, but also in the emerging government bond markets as well. We've been trading a lot of that kind of stuff recently as well, Dan.
And with RV, we're talking just to unpick the term, is that's large in scale trades?
Yeah, so RV is basically moving up and down the curve, trying to find value, yield pickup. Mm-hmm. But we have been doing larger trades. We're a big asset manager, so the size of our trades is going to be bigger than some of the smaller guys. And that really has been, or used to be, the block for us doing it. Now, we actually have got a catalyst to do it because of pricing and liquidity, and we can use that, and the intelligence that we've got on where that liquidity is makes it more profitable for us to re-enter that business.
So if you were looking at the month ahead, are there any potential pitfalls or things that trading desks ought to be wary of, and are there particular ways they can then prepare for that?
It's a very interesting thing. We were looking at this yesterday. There's an old adage, being a guy who's been in the market a long while, that you should very rarely trade between the two turkeys, so Thanksgiving and Christmas. So the month ahead is always a challenging time for liquidity. However, if we look across all of the asset classes, we don't see that manifesting itself at all this year.
Really?
We see the environment very strong, liquidity is good. Interestingly, one thing we were looking at was bank profitability, and I think this just shows you what's happening to bid-offer spread in the government bond market. The investment banks are turning over more than they've ever turned over, but the revenue they're producing has decreased significantly.
Yeah.
We've seen that from most of the names that we're familiar with. And I think that's just because they can't make as much money out of the business because it's so competitive now.
Yeah.
But I think we'll be, exactly. But I think we'll be okay into the end of the year. Obviously, I think everything's out there with the central banks now. We're all aware of what's happening at the Fed. We're aware of what's happening in our own central bank. We've got a good grip on what's happening in Europe. Mm-hmm. So I don't think there's too many black swans on the horizon.
Yeah. There was the repo market at the end of last year. It became very, very difficult. And that can include the government bond market significantly because people use government bonds as collateral. So do you think could that prove to be a hiccup?
But less, because obviously if you're clearing your derivatives, in fact you're going to be posting cash. Whereas previously, which I suppose if you've got gilts, then you're going to repo those to get cash, and it'll be a bit more expensive. But no, the repo market's been operating well at the moment, so we're happy. We don't see any reasons that should hit any issues, I think, coming into the year end.
And for the client themselves, for the end investor, it can be difficult to quantify or to understand how trading execution is being best managed, particularly in the fixed income space. So how do you see transaction cost analysis or best execution being proven most effectively to the end investor? What do they need to look out for?
The way we look at it is we look at how much of the bid-offer spread is eradicated through the execution process. So, you know, if the bid offer spread is wide, which is not necessarily in a lot of the government bond market, you know, we're judging by how we're narrowing it down in that execution phase. And we're happy to show those cost savings to any of our clients. You know, it's something, especially when you would be in a more buy and maintain arena, the implementation cost is everything, and that is a key part of the process of managing that money. And even on big rates trades, when we're doing those, you know, you want to identify the potential cost. What's becoming more and more important to us is gauging pre-trade what we anticipate the cost to be, and we can use that by crunching the TCA data. So what we expect to pay for a trade, that might potentially mean that a fund manager might not put the trade on if it's deemed to be too expensive on the return that they're trying to seek out of the trade, especially in RV. Now, quite clearly, you know, the way that we've approached our business here at AXA IM, it's all been about crunching the data to see where we have that advantage, and it's something that we started back in the 2000s when we launched the trading team, was to get as much data to give us as much intelligence to make the right informed decisions on how we execute. And now the banks like that, because the banks are fighting for the business, and if they have that strong pricing, strong size capability, they know that people can identify that, and that gives them an advantage. So if you don't identify it and don't use it, then you're not doing the right thing for your client.
That's great. Lee Sanders, thank you very much.
Thanks, Dan.
Thank you very much for watching Trader TV. I'd like to thank our guests, Brett Chappell of Nordea Investment Management, Lee Sanders at AXA Investment Managers, and you for watching. Join us again next month for Trader TV.